Hello, everybody. How are you? Today's activity will climax our discussions on financial literacy. All right. So we started by talking about credit cards under section number 10, where we looked at how you can find the minimum payment. You can find the minimum payment. All right. And you can also find the financial charge or the finance charge on a credit card. Is that okay? So we looked at a typical credit card agreement. Okay, we took a practical example where we looked at a typical credit card agreement and we did the analysis on that. Is that okay? Now we moved ahead and we came to section number 11 where we started talking about loans. And under loans, we spoke about mortgages, right? And then we also spoke about car loans. Now, under loans, let me take you back a little bit. Under loans, we looked at how you can use Excel to find your monthly payment. And that is where we looked at the PMT function. The PMT function represents what? Payment. And we also looked at another function we call the present value function. Okay, or the PV function. And the PV function, we said that the PV function is used to estimate how much of a loan you can afford. Is that okay? So we looked at that. And we also came down and looked at a very important formula. And we looked at how much mortgage is affordable, all right? And we use the total expense ratio to do that. Is that okay? Now, after you have taken all these loans, the most important thing you should be thinking about is your retirement, all right? Because when you retire, at that point, you are not as active as you used to be. So it is very important that you think about your retirement. So today we are going to look at retirement, and of concern, we look at the 401k plan, savings plan. Is that okay? Now, the purpose of this activity is to gain an understanding of the long-term effects of regular savings. Have you heard the expression, time is money? And we are going to find out what this really means. Now, we will explain the tax savings with 401k contributions, and then we are also going to introduce another Excel function we call the FV function or the future value function. All right, and we'll look at how we can use that. Okay, this is very similar to the PV function and the PMT function. So don't get confused. And I'm going to differentiate between these three functions, the PMT, the PV, and the FV function. So watch out. Now, we are also going to look at how you can quantify the impact of company match. Now, some companies will match your contribution. So if you contribute, say, $50, the company will say, okay, we are going to do 50% of that. So that will be $25. And we look at that, get the matching of companies. And then compare starting early in a savings plan versus starting later with larger regular contributions. So here we are going to analyze a scenario between two friends, Albert and Cain. All right, one started his investment 20 years ahead of the other, and the other wanted to catch up. So he doubled his contribution, and we will see whether after doubling his contribution, he'll be able to catch up with his friend. Though at the end of the day, how much they invested was the same. Is that okay? It's a very interesting conversation, and let's get into it. Now, as an introduction, many companies offer a 401k savings plan for their employees' retirement as part of a benefit package. Now, with the 401k savings plan, money is removed from each paycheck and placed in an interest-bearing account on your behalf. Most companies match a portion, usually some percentage, of your contributions to the account, which further increases the yield on your investments. Income tax is only applied when monies are withdrawn from the account. So what happens is that before income taxes are applied on your income, 401k deductions have already been made. So those are deducted before income taxes are applied. So if in the future you want to withdraw money from that account, okay, there's a law that says that some interest or some tax must be applied anytime you want to go into the account before maturity, right? And even after maturity, there's some agreement on that. But we shall just look at the basics. We are not going to look at the law that governs 401k plan. Now, given that 401ks are intended for retirement savings, there is generally a penalty for early withdrawals. Now, for the purposes of this activity, we were going to assume that all 401k accounts are left intact as long as indicated. Okay, so we're going to assume that you do not go into the account, all right? Now, it is important to remember that retirement plans are based on multiple routine deposits into an interest-bearing account, okay? Now, as we have always done, we are going to take a practical scenario for our discussion. So we look at paychecks and 401k plans. Is that okay? So we're going to talk about this lady, Celeste, and Celeste has an annual salary of $36,000. Her company offers a 401k plan, but she's unsure how this investment would impact her tax, would impact her take-home pay. She knows her income taxes are 15% of her pay, and that if she were to enroll, the company requires a minimum 401k contribution of $100 per month. Now, look at these two tables. So the tables right in front of you right now, this is the table if Celeste decides not to invest in a 401k plan. And then if she decides to invest in the 401k plan, okay, that is the one on your right. Is that okay? Now, let's look at her monthly pay. So this is her annual salary, how much she makes in a year. So to find her monthly income, we have to divide 36,000 by what? By 12. So she gets 3,000 every month. Is that okay? So because she is not investing in a 401k plan, on this table right here, we are saying that $0 goes into 401k. Now we have to do pay minus contribution. So 3,000 minus 0, so everything goes to her, right? Now, don't forget that we said 15% of her pay goes into income taxes. So we are going to do 15% of 3,000, and that will give us what? 450. Is that okay? So to know her take-home pay, how much she takes home, we are going to subtract the income taxes from her monthly pay. All right. So we do 3,000 minus 450, and that gives us $2,550. So this is how much Celeste would take home if she decides to not to enroll in the 401k plan. Now let's look at on the flip side. If she decides to enroll in the 401k plan and making a contribution of what, $100 every month, so her pay still remains at 3,000. So we do pay minus contribution. Now she has what? 2,900. Now we apply 15% income tax on 2,900, and that is how much goes into income taxes. Now her take home, right? How much does Celeste take home? Now Celeste takes home 2,465. Is that okay? Now let's do some analysis on these scenarios. Now, how much is Celeste saving in income taxes by investing in the 401k savings plan? How much is she saving? She is saving what? $15. So here we are looking at the difference between this and that. Is that okay? How much less is Celeste take home pay if she enrolls in the 401k plan? So now we look at that. So here we are looking at this versus that. Is that okay? And that is how much less. Okay, nice. Now note something. Note that because of the 15% of taxes that Celeste does not pay on the $100, her paycheck is not really reduced by 100. Do you see that? Nice. All right. Now, there's a bit right here, right? So this is what happens. So Celeste's HR representative informs her that the company will match 50% of her 401k contributions. So Celeste gets inspired, all right, to raise her 401k contribution to 150 each month and take advantage of the company's 50% matching. So the company says, okay, whatever amount you decide to contribute, we are going to contribute 50% of that. And let's look at that scenario. Okay, nice. So Celeste's monthly pay still remains $3,000. Her contribution now has been raised to 150, right? So we do pay minus contribution, and Celeste has 2,850. Okay, we are doing this because income taxes are not applied on 401k plan. So we have to take that out of her monthly pay before we apply income taxes. And we do 15% on 2,850. So we have 427.50. And how much is Celeste take home? We subtract that. And this is how much Celeste takes home. Now, how much will Celeste contribute to the 401k annually? How much will she contribute to the 401k annually? So for the year, right? So we have to do her contribution, which is $150 multiplied by what? By 12. And Celeste contributes what? $1,800 every year. Now, the company contributes 50%. So that is half of what Celeste will contribute. So we do 50% of $1,800 and the company contributes $900. Gucci. Yeah, so we did half of that. So 0.5 times 1,800 gives you what? 900. How much money total will be invested into the account each year, assuming no charges are made? Okay, so we have to look at how much Celeste is contributing plus her company's contribution, right? So 1,800 plus 900 altogether gives you 2,700, and that goes into Celeste's 401k account. Sounds good? All right, nice. Now, here we want to do some ratio, right? We want to write a ratio that represents the company's annual contribution to the total amount invested annually, okay? And we do 900 over the total. So the company really contributes a third, okay, of Celeste's contribution. Now, if you want to write a meaningful sentence to do this, we write that Celeste, 1/3 of Celeste's 401k account was contributed by the company. As simple as that. Is that okay? And that's the interpretation for the ratio. Now, if Celeste remains with the company for 40 years, she will eventually have deposits that sum to $108,000. Assuming no charges have been made to the 401k savings plan, how much of this amount was provided by the company? So we are looking at what? 40 years. Okay, so how much will be provided by the company will be that. So 1/3 of 108,000 will be equal to 36,000. And that is how much the company will contribute. Is that okay? So that is how much the company is going to contribute. Sounds good? Sweet. I'm sure you may be wondering how we came up with this number. And this number is coming from the fact that we had said in the previous slide that for the whole year, the company contributes, the company and Celeste together contribute what? 2,700. So 2,700 multiplied by 40 years. So every year, Celeste's contribution together with her companies is 2,700. So we multiplied that by 40, and that gave us 108,000. Okay, so out of the 40 years, if you wanted to know how much of this contribution was done by the company, we have already said that 1/3 of that contribution is done by the company. So we divide that by 3, and that gave us 36,000. That's a lot of money, right? Sweet. Now, we are going to look at how we can use Excel to find the future value. And we already have an idea how this works. So really, if you haven't watched my video on the credit cards and loans, okay, specifically loans, right, where we looked at the PMT and the PV function, we already dealt with this. Okay, now this is what you put in Excel, okay, and the Excel will give you everything, including the interest over the period. Is that okay? So nice. Let me see if we can do that on Excel right here. So let me share something with you. So I already have Excel open somewhere right there. Good. So let me share that. Okay. So let's look at that particular Excel function. So we said that if we want to do that, we are going to do equal sign, and this function is already in Excel. So if you do FV, you introduce parentheses, and then the rate, okay, the rate was given as, so you have to make sure you change that to a decimal. So you have 0.0299, and you have to divide that by 12 to give you the monthly interest, right? And then the number of payments. So because it's for 40 years, okay, and we are doing monthly contributions, so we have to do 12. That's the number of months in a year multiplied by the number of years, okay, and that gives you the number of payments. Minus, now if we put Celeste's contribution together with her company's, that should give us a total of 225, okay, and then you close the parentheses, and that gives you how much will be in the account at the end of the 40 years, okay? Is this the same as what you have right there? So this gives you, you should be able to use, so at the FV function typically is used to estimate how much, okay, will be in the account, knowing the interest and how long the investment is done, okay? So let's go back to our slide and continue with our discussions. So this is what we did. We put in Excel, and Excel gave us everything at the end of the 40 years. Okay, so nice. Now, so by pressing enter, that gives you that, and that was the Excel process. Now, how much more is in Celeste's account than what she invested? Okay, so really, this is how much was generated by Excel. We do minus 40 by 1800, okay? And that gives us how much more was in Celeste's account. Do you remember where these numbers are coming from? Okay, nice. So therefore, let's continue right here. Now let's consider what happens when Celeste increases her monthly contribution to 200. Now, if Celeste decides to increase her monthly contribution to 200, based on the previous information, what will her company contribute? Because the company contributes 50%, the company is going to contribute $100 each month. Now, assuming Celeste is depositing 200 into an account that pays 2.99% annually, and the company is contributing the amount determined in the problem above, we want to find how much will be in Celeste's account at the end of the 40 years using the FV function. Okay, so equal sign FV parentheses, the rate must be changed to a decimal, that's the rate. Okay, now you divide that by 12 to get the monthly rate, and then you introduce a comma, 40 by 12. Okay, we are doing 40 because 40 years times the number of months in a year, right? And that gives you the total amount of deposits that will go into the account. Now, Celeste contributes 200. The company contributes what, 50% of that. So together, $300 will go into the account. Is that okay? And how much goes into the account must be a negative. Is that right? And that is it. Now, how much of this was deposited by Celeste? So 200 by 12 by 40, 96,000. And how about her company? Her company contributes 50% every month. So that will be 100 by 12 by 40, and the company contributes 48,000. How much interest was earned? Okay, so we look at how much Excel gave us, how much was generated by Excel, and then we take out her personal contribution and her company's contribution. And at the end of the period, this is just interest on the money. So really, the earlier you decide to invest in a 401k plan, the better, right? Now, what is the total amount that Celeste would profit by participating in this 401k plan? Okay, so really, how much her company contributes is to her credit. She didn't really expect that, right? So together, you have to put the interest together with how much her company deposits, and this is money, free money for Celeste. Okay, if she had decided to put it in a regular savings account, she wouldn't earn that amount. Okay, nice. All right, now we are looking at another person, Julia, right? So Julia deposited 100 each month for 35 years into a 401k savings account, and the account pays 3.99% annually, and her employer matches 100%. This is a very good company, isn't it? All right. Now we want to answer each of the following questions. How much money would Julia have contributed over the 35 years? So for 35 years, we want to know how much Julia would have contributed, right? So Julia would do 100 multiplied by 12 because there are 12 months in a year, and multiply by the number of years. So Julia will contribute 42,000. And looking at the fact that the company does 100% matching, the company is going to contribute the same amount. Now, what will her balance be at the end of 35 years? And this is where we use the FV function. So we have to use the FV function in Excel, and Excel will give us how much will be in the account at the end of the period. How much did Julia earn in interest over 35 years? So this is it. So now, how much Excel gives you minus Julia's contribution together with that of a company, all right? And this is just interest on the account at the end of 35 years. Gucci, right? Interesting. All right, so really, this same plan, so if you have a kid, you know, the most expensive investment every parent or everybody growing up would get into is education. College is expensive, and you can use this same FV function to work on college savings plan. So if you inquire, some banks have this savings college savings plan. Okay, so Excel's FV function can also be used for other types of savings plans, such as 529 college savings plans, which are designed to encourage parents and grandparents to save for future college expenses. Now, tax savings vary by state, but Indiana residents can qualify for up to $1,000 tax credit each year. Now, we want to try the following example for a college savings plan. So the Smiths, all right, they look like a very responsible family, have just had a new baby daughter, Kennedy. So they realized the importance of saving for a college early. So they opened a 529 account for their daughter. Now, they plan to save $50 each month until she turns 18 in an account earning 4% APR. All right. Now, what would Kennedy's parents type in Excel to determine how much will be in the account when Kennedy is 18 years old? And here, Excel comes in handy. Cool Excel. So you put that function in Excel. All right. And that gives you how much will be in the account. We want to find the balance, so you do that, and that will be the balance when Kennedy is 18. All right. How much will her parents have deposited into the 529 account. So the parents would have just contributed what? 12. Okay, how do you do that? 12 by 18 by $50, right? And that is $10,800. And how much interest? So you subtract how much their total contributions will be from what Excel gives you, right? And that gives you an interest of 4979.62. Okay, now if her parents decide to increase the amount saved each month to 100, we want to know the balance at the end of the 18 years, and Excel will do that for you as well. And that is it. Okay, nice. So really, you can be your own financial consultant. Okay, look at the rate on the market, sit behind your computer, open Excel, do your own adjustments, and see what you can do to help your daughter or your son or whoever you want to help with college expenses. Okay, now this is where we talk about the time value of money. Time value of money. So the two friends I spoke to you earlier about, Cain and Albert, have different approaches to retirement. Albert saves 100 every month for 40 years. Cain waits 20 years to begin saving. But Cain is trying to be smart, right? He hasn't done the math. So he thinks that he will tie Albert in the end if he deposits 200 each month. Now, both friends are investing in an account with an APR of 3.99. Now, let's look at the math. Let's look at the numbers. What do you think before we even get into this? So Albert started 20 years before Cain. I want to get your thoughts on that. And Albert starts with what, 100 every month for 40 years. Now Cain waits 20 years and decides to do twice of what Albert was contributing at the same rate of 3.99. What do you think? Do you think they will have the same amount at the end of the period? Now let's look at it. We are going to realize that their total contributions will be the same, but time is money. All right, and earlier, the better. So the future value, look at it. So this is it. Okay, so Albert does 100, Cain does what? 200. And look at it. So Albert gets more money than Cain. Investor contributions stands at the same value by each of them. So time is very, very important. Okay, and the interest earned, is this intriguing? Time is of the essence. Okay, so the earlier, the better. So we want to write the ratio of what Cain's interest earned to Albert's interest earned, and let's look at that. So Cain to Albert. While Cain contributed the same amount as Albert, his interest was only 36% of the amount of Albert's interest. Okay, how much did Cain lose by starting 20 years later? So Cain actually lost that amount, 44,628. That's a whooping amount of money, right? That's a lot. Now compare Albert's balance to that of Cain and look at that. So here we use relative change to find the percentage, and Albert's 40-year retirement balance is 60.9% more than Cain's 20-year retirement balance, even though they each deposited the same amount of money. And here we put these two, we put Albert's retirement savings on a graph, okay? And the line curves upwards. So this kind of graph is not a linear graph. It's really what? An exponential growth. Okay, so retirement account is an exponential growth function. Okay, so the amount grows exponentially. Okay, nice. And what is the retirement account balance? Okay, and that is that. Okay. Is that right? Sweet. And we are just doing the relative change Abed's retirement account balance increased 222% from year 20 to what? The 40th year. Now, we want to explore Abed's contribution frequency. We want to do some exploration right here. Now, suppose Abed decided to have taken $50 from each of his paycheck. He is paid on the 10th and the 25th. So bi-weekly, right? So this is a bi-weekly payment structure. Look at it closely. Okay. So instead of doing a single deduction of 100 at the end of the month, he decides to do bi-weekly investment. And let's look at it. Let's do the analysis. And he's going to make more money. And this is the reason. So if he still intends to invest in the account with an APR of 3.99 over the next 40 years, will he have the same account balance as calculated with a single monthly payment? Explain. No. The early investment will start gaining interest. So what he pays on the 10th, by the time he gets to the 25th, within that period, he will still make some interest on his balance. Okay, so the money he has in his account between the 10th and the 25th will accrue some interest. So the balance wouldn't be the same. So you can begin to do this analysis. So instead of waiting to make a single deposit, if you break that into two, you make some extra money on your money. Okay. Now, what adjustment will need to be made to the Excel function? So here, the only adjustment that needs to be made is that here we do 24 because 2 by what? 12 by 2 deposits per year. Is that okay? Nice. So instead of 12 single deposits, his deposits will change to 24 because he's doing twice 2 deposits, and that is the difference. Okay. So if you compare the two, okay, that is the difference. Nice. Now here, I'll take you through some practice problems, okay? Some practical scenarios. Now, Richard has enrolled in a 401k savings plan. He intends to deposit $250 each month. His employer does not contribute to his account. So his employer does not contribute to his account, okay? Now, if his account pays 3.5% annually, how much will be in his account in 20 years? Okay, so yes, we have to use the FV function. Okay, so we have to do equal sign FV, and the rate is what? 3.5, so we have 0.035. We divide that by 12, okay? Now, number of contributions. He contributes, so that will be 12 multiplied by the number of years, comma, and then minus his contribution because the company does not contribute. And that's what we give Excel. Now, how much will be in his account in 40 years? Okay, and that is how much will be in account using the FV function. Okay, so here instead of 20, you use 40, right? So you replace that, and that gives you the second one. Now, is the balance after 40 years twice after 20 years? No. Do you see that? So the 20-year balance is what percent of the 40-year balance? That's about 33% of the 40-year balance. So you do the ratio, and that is it. Sounds good? Okay. Okay, now let's look at practice number 2. Maria works for a not-for-profit company that offers 50% matching for the 403B plan. A 403B plan is very similar to 401k plan and allows employees to invest their money pre-tax. The plan predicts investors will earn 4.25%. Now, if Maria invests $200 per month, what can be typed in Excel to determine how much will be in the account when she retires in 30 years? Find the value with the Excel. So this is the case, right? So the rate So equal sign FV, parentheses, the rate divided by 12, and 12 by 30. Now, Maria contributes that. Her company does 50%. 50% of 200 is 100. You add that, and that gives you 300. So that is how much come out. Now, if Maria's tax rate is 15%, what is her monthly tax savings? Okay, so 30 per month. Is that okay? So 30 per month. And how did you get that? So you had to do 15% of what? Of the $200 she contributes, and that is what? $30. She saved $30. Now, how much will this be over 30 years? Okay, and that is it. So that is what? $30 multiplied by 12 by 30 years, and that gave you that much. Now, how much does Maria invest over the 30 years? So, and how much more is in the account than what she invests? So Maria is actually doing 200, right? Multiplied by 12 and multiplied by how many years? 30 years. And that gives you that. So this value is coming from the fact that 20 multiplied by 12 and multiplied by what? 30. And that's how Maria contributes. And this is more in the account than what she invested. Is that okay? Sweet. And that brings us to the end of our discussions on retirement savings. Now, a quick recap, especially with the Excel functions. Now we looked at PMT, okay? PMT is used to estimate what? The monthly payment. Is that okay? And I talk about PV. PV is used to estimate how much of a loan you can afford knowing the monthly payment. Okay? And FV, for short, the future value is used to estimate retirement contributions. So anytime you come across a retirement problem, you have to use the FV function. Okay? So this brings us to the end of our financial literacy conversation. And we've spoken about the pillars that will make you financially independent. Okay? So really, you can be your own financial consultant. So if you want to buy a house, you can sit down and do your own numbers and estimate. So if you want to put how much you pay as rent into a mortgage, you can do all those analysis. Okay? And if you want to look at how much you can afford to buy a car or any other thing, you can do all these analysis, okay? And you can sit down knowing the current rate of retirement on the market. You can estimate how much will be in your account, considering your age, how much you want to deposit towards your retirement, okay? So on this note, I want to thank you very much for your time, and I will see you soon. Thank you. Be good. Bye.